my base case has been for a while that the 2020s are going to be a more inflationary decade than the 2010s.
This week's specials with Miles Franklin Precious Metal Investments. Silver Philharmonics for only $360 over spot. Backdated Silver Eagles for only $850 over spot. And 100-ounce Royal Canadian Mint silver bars for only $265 over spot per ounce. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today, one of our most popular guests, Lyn Alden from LynAlden.com. Lyn, thank you so much for joining us today.
Thanks for having me. Happy to be here.
It's great to have you, and our viewers very much appreciate your analysis of the markets. And one of the first topics I'd like to discuss is inflation, because, you know, we've been seeing the worst inflation we've had in 30 years. You've been reporting a lot on this and commenting on this and how this is looking, a lot of people are saying it's looking like the 70s, but you've actually been pointing out it's been looking more like the 1940s. Can you expand on this?
Yeah, so if you look at the 70s, it's really about the type of inflation you're getting. And so in the 1970s, a lot of that inflation was coming from bank lending. And so basically, if you look at the demographics curve of the United States and much of the rest of the world, basically that was kind of like, you know, a very high level of population growth, especially population coming into adulthood. And so there's a lot of kind of, you know, household formation, bank lending, and then that was exacerbated by the fact that there was a fiscal deficit. But if you look at a long-term chart, the deficits were not massive compared to other parts of the history. It was that combination of that bank lending and then fueled by the deficits. Plus you had oil production in the United States peaked in 1970. And so you had a real constraint that you ran into where you had to start importing your oil while you also had that very strong demand growth. And so there are a bunch of factors that led into that inflation, combined with the fact that you went off the gold standard. And so you'd lost that anchor. If you look at the 1940s, it's a much different story because the inflation was not driven by bank lending. It was driven by massive fiscal spending to obviously to fight World War II. But, you know, most of that spending is domestic, right? So you're funding factories, you're funding all this stuff. And when the war's over, you're repurposing those factories. You're doing GI bills to send people, 8 million people to college and technical schools and get them set up with mortgages, things like that. So basically, that was a very fiscal heavy environment. And also debt levels are very, very high, especially in the federal sector. And so when you had that very high inflation, they were unable to raise interest rates. They just had to hold rates low and let the inflation kind of burn away a lot of the debt. Whereas in the 70s, because debts as a percentage of GDP was so low, they were able to raise rates to try to combat inflation. And eventually, Volcker was able to do that. And so there are a bunch of different factors. If we look at the 2020s, so far it's more like the 40s in the sense that the debt picture looks very similar. And the inflation we're seeing is not coming from bank lending, but rather is coming from that fiscal sector, the fiscal spending, basically a war on COVID or a war on, however you want to phrase it. Basically, we the president has referred to it as kind of wartime spending, right? That's kind of how they're looking at it. And that's how it's showing up in the long-term chart as well. So a lot of the money creation is not coming from banks lending, but from the fiscal sector spending it into the economy and then having a lot of their bonds, purchased on the secondary market by the Federal Reserve.
And what is your perspective on how the Fed is reacting to this? And I mean, it looks like we're going to see even higher inflation numbers for this past November coming out on Friday. So your perspective on how the Fed may act?
So they're clearly now, I think the whole purpose was to basically be behind the curve because they know they cannot raise interest rates to say positive real levels, right? So if inflation's currently 6% official CPI, they can't raise it to 7% given how much debt and interest that would be on the debt. And so really it's about kind of an expectation management. They were kind of playing down. They were kind of saying it was going to be transitory. And that was clearly not the case, or at least, not as transitory as they thought. Now they're kind of, I think they're catching up and they're going to try to tighten. But they're tightening from a position of being behind the curve. And it's one of those things where it's not even clear that tightening would have much of an impact on inflation because the inflation is coming from the fiscal sector combined with real world constraints like supply chain issues and other things like that. And so I think they're going to try to tighten until something breaks, either yield curve inverts or credit markets break, which is what happened in late 2018. That's kind of what made Powell have to, the famous Powell pivot where they were on autopilot, and then credit markets broke for 6 weeks, and then they were not on autopilot anymore. Or you could have a treasury market dysfunction like you saw in March 2020. I don't think we're close to that. So I would really watch credit markets and the yield curve to see what kind of things happen. But essentially, I think they're mandated at this point. They have kind of the dual mandate, and then they have kind of the underlying mandate. So the dual mandate is maximum employment and maintain, keep a lid on inflation. And with inflation way above trend, while a lot of the employment numbers are looking somewhat better, at least on the surface, I think they're clearly shifting towards that controlling that inflation side. Their third kind of unstated mandate is to maintain financial stability. So you can't have treasury market go illiquid. You can't have high yield bond market go illiquid. And so they if you see kind of damage in one of those areas, they put out the fire there. So they're juggling all these different things, and right now inflation is the one that they're getting heat for, and so at least for a period of time, that's the one they're going after to put that fire out.
Now, when it comes to how this might impact inflation, I mean, I know you were recently on Palisade Radio a few weeks ago and saying that, well, inflation is partly because of what the Fed is doing. They're expanding the money supply, but it also has to do with the supply chain. So even if the Fed changes their policy and all of that, don't we still have supply chain issues causing some of this inflation?
Yeah, basically there's a demand side and there's a supply side. And at any given time, supply is not infinite, right? It can't just change on a dime. And so we had basically a lot of fiscal stimulus, which gave everyone the ability to consume more. We increased everyone's demand in a world where we have real world constraints. And especially because people are locked down, some of the constraints are even tighter than before, rather than increasing. And so that combination of that demand and that supply, the only way that the Fed tightening can potentially impact that is by reducing demand, right? If they make stocks fall, if they make banks lend even less than they are now, that can basically reduce consumer demand, and then ironically that can at least potentially in the temporary term kind of quell inflation. I think the bigger thing to watch is fiscal spending, because that's the thing that has a more durable impact on inflation. So 2020 and early 2021, we had these big fiscal stimulus bills. The infrastructure one is not really kind of near-term focused, so that's more of a long-term thing, and it's not as big as some of the others. And so right now we're looking at a fiscal cliff for 2022, where they're still kind of debating on that other bill. We'll see what they get through, but assuming they don't get anything big through for 2022, then a lot of that fiscal spending dries up, and you should see a reduction in how fast money supply is growing. Now, those supply chains are still there. I mean, we're still short on truckers. We're still short on ports capacity, things like that. I mean, this doesn't work itself out very quickly. And it's also a global market, right? So it depends what China's doing with their economy. It depends what Europe's doing with their economy, some of these really big sources of demand. But basically, I think the base case going forward is that, the November inflation print's going to be pretty hot, I think. I mean, right now economists are expecting that the year-over-year numbers will be higher than the prior month, but that month-over-month will be a little bit maybe lower, right? So you could have basically that inflation still going higher kind of in that intermediate term, but maybe that it's leveling off. And if you start to see signs that it rolls over, I wouldn't be surprised, because when you have kind of a lag after fiscal stimulus, you'd eventually see inflation kind of peak and then maybe roll over as well, subject to whenever the next fiscal stimulus is, or subject to if you start to see kind of a persistent rise in wages, right? Because if you get that wage price spiral, right? So I think inflation's sticky, but I think too many people think linearly. They assume it's going to be a straight line. Whereas if you look at the 40s or the 70s, both those periods, inflation was not a straight line. You'd see inflation go up, and then it would cool off a little bit, and then it would go up again. And there are a bunch of factors there. There are different kind of shocks that happened to the system. There was different attempts by the Federal Reserve or fiscal authorities to kind of rein it in. There were price and wage controls in some cases. And so there are a lot of those things that impact demand and supply to watch out for. And I don't think the 2020s are going to be a straight line either. People say this could go on for 10 years, 20 years, 30 years. How long do you think this inflation problem will be around? It depends on a couple of variables, especially related to China and the United States. But essentially, my base case has been for a while that the 2020s are going to be a more inflationary decade than the 2010s. And that's not a super high bar to cross. So I think there's a big range for how that could turn out. And I think the biggest factor is probably what happens with fiscal stimulus in the United States, Europe, and China. That's kind of the big question for how inflationary this period is going to be. I think we're going to be in a period of kind of persistently negative real yields. So I think basically bond yields are going to be below inflation for much of the decade, regardless of how high inflation is. So if inflation comes back down for a period of time to maybe be 2%, 3%, right, it's still higher than bond yields are, let alone when inflation officially is over 6% or, could touch 7%, who knows. So I think basically we're in an environment of kind of financial repression where you have bond yields super low, inflation's currently moderately hot, by historical standards. It's hot over the past couple of decades. And I think that basically we're not going to have a straight line, but the 2020s could very much see more of this. For example, I can imagine a scenario where they try to tighten policy. They kind of rein inflation in for a period of time because there's no more fiscal stimulus coming. And then you kind of start rolling over a little bit. And then, people demand more fiscal stimulus and they, something happens in markets and they do another one. And we kind of start this multi-year cycle all over again. So I think we have to watch things in rate of change terms.
And I know one of the markets, gold, often anticipates inflation, and we've kind of seen that because ever since the beginning of this COVID pandemic, we saw gold rise quite a bit, but it's been going sideways really since it fell from August 2020. So your perspective on that as we enter fully, as we continue in this decade of inflation, then what indicators, what catalysts are you looking for? Or what signs are you looking for gold to break out of this sideways range and move higher?
So partially I'm looking at real yields. And so if you looked at gold's behavior in 2020, real yields were going down. And because gold's a very financialized markets, you have to look at the financialized version of real yield. So rather than just CPI, compared to yield, you look at what the treasury market's inflation expectations are, which basically compares the tipped yield to the normal yield, and you get that spread. And so that's kind of officially supposed to be the treasury market's, forward inflation expectation over a given period. But of course, the Fed is buying both sides of those bonds. So the Fed is, it's not a super clean market anymore. But nonetheless, gold has tracked that pretty closely. And what we saw basically is that, during the autumn period of 2020, real yields bottomed right when gold peaked. And then so real yields kind of started going sideways and gold started going choppy sideways. I think an additional factor in 2021, I didn't really see signs of this earlier, but in 2021, I think the big increase in the market cap of Bitcoin and maybe some of the other cryptos became large enough that it diverted fund flows that might have otherwise gone to gold. And so some of the continued weakness in gold in say 2021, when we started to get these pretty high inflation prints and gold didn't really seem to notice, I think basically if you were to add gold and Bitcoin together, would see that basically money flowed into that type of asset. And so let's if you go back and imagine a world where Satoshi Nakamoto never existed, these other asset classes were an option. You pretty much had gold and silver as your options in addition to any sort of other property. I think gold would have seen a stronger bid in 2021, but because it's the world we live in now, there's kind of this. It's gone through like a prism, and now there are multiple of these asset classes that investors can pick. And I think over time, a lot of them will not work out. Like I'm not saying people should go out and buy Dogecoin, for example. So I think that a lot of these will be filtered out. But I do think that some of them, like Bitcoin, have a reasonable shot at being around for a while. So I think we have to compare how those two kind of you can call them kind of alternative scarce monies in different ways. They have different pros and cons. One's more portable. One obviously has orders of magnitude longer track record and other properties that make it unique. And I think we have to see how investors kind of take to those over time.
The general atmosphere, it seems like, out there is that a lot of the people you just know, a lot of your friends are getting into cryptocurrencies. It's not so much with precious metals. I know a lot of people I talk to are maybe interested, are like, oh, that's interesting that you deal in precious metals. Okay. But they're not actively investing in it. However, they are actively investing in cryptocurrencies. So it seems like cryptocurrencies right now, at least on an anecdotal basis from my own experience, seem to be in quite a bit of a bubble right now and have there's that sense that it could be topping. Your perspective on that?
So I do think a lot of the crypto market's a bubble. And it's funny because, so Bitcoin, for example, had very good performance for the past couple of years. But if you look at what happened in the broader crypto space, it was like way more. You had these tiny projects go up dramatically. You had meme coins, like literally coins that are made as a joke, that become worth more than large banks in terms of market capitalization, like Dogecoin or even some of the others. And so I do think there's a lot of froth in that area. I don't really view a lot of froth in Bitcoin right now. It's going to have a volatile period for a while. But I do think that when you look out into the broader space, there's a lot of bubble-like attributes. A lot of funds, a lot of VCs have raised billions of dollars to market their products. And a big thing is we don't even have regulatory clarity yet. A lot of those. So, for example, we know that Bitcoin is not considered a security. Basically, doesn't pass what's called the Howey test, meaning that it didn't raise capital to have people go and then pursue a project and try to increase the value of that capital, right? So Bitcoin is classified as a property or commodity. And probably some of the hard forks are likewise. But a lot of the smart contract platforms are essentially securities. They basically look like equities in the sense that the teams raised capital and then went out and tried to make that project more valuable. But they didn't register themselves as securities. They didn't follow securities laws. We already had some entities get sued over that. And basically we have a lot of exchanges that the chairman of the SEC has said that most of them that because there's so many securities out there, a lot of them are carrying unregistered securities. And so I think basically we have to be prepared for the possibility of regulatory crackdowns in 2022, 2023. And that could really dent a lot of the crypto space, especially if it's already kind of in a, let's say it did top out or will top out next year, whenever it tops out, if it kind of eventually just kind of exhausts itself for this particular cycle. If you then lay a regulatory crackdown on top of that, that could get pretty brutal for that market. That could potentially give gold a bid. It could even give Bitcoin a bid to some extent because that's the crypto that's kind of immune to those sort of, at least around the margins, kind of because it doesn't have that specific issue of being a security. And so I do think that there is a lot of risk in that space. And these things can reverse quickly. Like we saw, for example, a lot of these unprofitable tech stocks had a really good year in 2021. Some of them had a really good year in 2020. Some of them kind of got into 2021 also doing well, but they've rolled over very, very sharply. Some of them might even be oversold at this point. I mean, some of them are probably decent companies, and just the whole sector has been absolutely crushed because, volatility feeds on itself. And I think you could see a similar thing in a lot of these cryptos. A lot of them are already way off their highs. Some of the meme coins, for example, are already way off their highs. And I do think that basically there's a lot of risk for that space. And so one of the favors to gold would be that if that space does have trouble and you're in a negative real yield environment, it's possible some capital could flow back into gold.
And you're thinking, though, that Bitcoin itself is more stable than these other cryptocurrencies?
Well, in a technical sense, yes. One is it's more decentralized than the others. And so it's basically the other ones have kind of discretionary monetary policies where a central group of developers can change the monetary policy. Whereas Bitcoin, because of the path dependence to the way it came into being, plus the way it's designed, it has the most security and the most decentralization. And then it has the added benefit that Satoshi never marketed as he never said, hey, get this thing, get rich. He never raised capital. So he basically across the board, it's unanimous that Bitcoin, whatever governments may think of it, obviously China, for example, is not thrilled with it. Some countries may ban it, but it's not a security. That's the point. It's a kind of a distinction. They could go after it for other reasons, but it's not a security and it doesn't rely on these centralized hubs. And so I think basically if you were to see a broad crackdown in the crypto space, Bitcoin probably would take a hit. But if there's one I'd be in, it would be that one because it wouldn't be necessarily facing the same kind of the unregistered security problem that a lot of those other ones have. And so it's possible that in that ecosystem, you could have some capital flow back to Bitcoin. I think it's too early to tell because we have to see what happens with Gary Gensler and the SEC in the coming 2 years. But I would be very cautious if I owned a lot of these other projects or was just really overweight that whole space.
Now, with respect to Bitcoin in particular, looking at the recent price action, we just saw it fall below 50,000. We saw it break, though, above the former all-time high of around 60 or so. So your perspective where it stands really on a technical level currently.
So I think we need a little bit more information. So for example, it broke a couple support lines and we're going to see if it tries to recapture those. The advantage of the Bitcoin space is that because it's kind of a public ledger, you can go back and do analysis and see what kind of entities are selling, right? So you can't necessarily see who's selling, but you can see, for example, if coins are sold, how long were they held on chain before they sold? So, for example, are people that bought 2 years ago selling or people that bought 6 days ago selling? And so what we've seen recently is that a lot of the selling pressure is short-term people, and a lot of them are now below their cost basis. So generally a sign you see that in bear markets for Bitcoin, people are willing to sell at a loss and then keep selling. That's kind of what defines a bear market. They just want to get out of the position. Whereas in a bull market, you often see corrections go down. So they kind of get to their cost basis, and then they kind of refuse to sell below their cost basis because they still want to stay in the trade. And they're like, well, I'm not going to sell anymore. And so right now we're kind of on that line. So I think right now it's too early to say. We have to kind of see what happens in the weeks ahead. I think it could certainly consolidate in this big choppy sideways patterns for a while. I think it's going to partially depend on what happens with the Fed. I think now that it's $1 trillion asset class, more or less, right? It was a little over $1 trillion. Now I think it's a little bit under $1 trillion after this correction, but it's about $1 trillion. And that brings it up to the macro level where, before Bitcoin was obviously tied to liquidity, but it was mostly its own thing. Whereas now it's big enough that, the macro forces can influence it. Wall Street's involved. And so they could sell it. And so my overall kind of forecast is for volatility, and I don't really have a clear kind of near-term 6-month forecast until I see more data. So really, I'm kind of watching multiple asset classes rather than, say, focusing heavily on that one.
And as for the stock market, a lot of people I've been talking to have been saying that it probably will have a final melt up. So we really haven't seen the blow off top yet. But others have been saying, no, actually, it looks like we're topping out right now. Where do you see the stock market right now?
So we clearly took out a lot of froth in some of the names. I think that there are a lot of value stocks that are pretty attractive. Healthcare, for example, was sold off because of impending regulation that looks like it won't be as severe as some thought. And that's caught a little bit of a bid in this recent weakness because, they have risks, but really the economic cycle is not really one of them as far as healthcare sector is concerned. So that place looks attractive. And in general, I mean, even some of these former bubble stocks that are down 60, 70% from their highs, there's a certain price where even some of those start to become attractive. And so I do think that you could have a stabilization. Ironically, what we see in the past is that when the Fed tightens, it's actually pretty good for the stock market. And generally because they're only able to tighten when the economy is reasonable enough that they tighten and they're able to keep doing it. It's really when the Fed tries to tighten and then weakens, and then they start going dovish. That's when you start to have kind of troubles. So I'm kind of watching a couple indicators to see what happens. I mean, if they make it clear that they're kind of out of touch in some way. So, for example, in 2018, Powell said he's on autopilot with tightening, and the markets threw a fit. Right? So that was an example of for a while they were tightening and the market liked it, but then towards the end of it, when they seemed like they were just going to go full speed ahead, the market threw a tantrum. And so, right now we're kind of in the early stage of tightening where you're tightening from a negative base, right? You're tightening from zero rates and $120 billion a month in QE. And so tightening in the quote unquote tightening is only $90 billion a month in QE and then only $60 billion a month in QE. And then maybe you get to the point where there's zero rates and no QE. And then we start talking about 25 basis point hikes, when inflation is 6%, right? So I think there's still potential little ways to go. We'll see how the market behaves. Overall, I would kind of focus on certain sectors over others. I think there's a lot of fear in the market, which I think makes the contrarians kind of bullish. But we also still see that, especially among the really big technology companies, valuations are still pretty high.
And I think that's what a lot of people are looking at, like the PE ratio is just, pretty much the highest they've been except for in the .com bubble. So, yeah, I mean, it seems like a lot of people are saying that on the general market is overvalued right now.
I think overall it is, but I think if you look under the surface, so for example, there are pretty attractive healthcare stocks trading for like a price to earnings ratio of 9, for example. There are home builders trade, sometimes they're viewed as risky, right? Because healthcare, you have to deal with regulation. Home builders are a very cyclical business. They got killed after the subprime mortgage crisis. I think conditions look a lot different now. And so there are these pockets of the market that are like, not only are they not expensive, they're actually cheaper than normal. Same thing, if you look at international markets, a lot of them are cheaper than normal, right? I mean, you can get actually high quality Japanese stocks that, they're paying 5% dividend yields. They have more cash than debt. They're not going to get you rich like, buying dog money at the right time and, getting out. It's not exciting to people, but there are pockets of value around the world and in the U.S. In certain sectors. And a lot of that high valuation is concentrated in a couple areas. So it was concentrated in some of these unprofitable new tech names. A lot of that got blown out by, 50, 60, 70% drawdowns recently. Some of them are still elevated, but a lot of them are now actually near their all-time low valuations. And then the rest of the valuations kind of concentrated in, say, the the FANG stocks, or now we call them, there's other acronyms now because there's, the mix has shifted a little bit. But if you look at Microsoft and Apple and some of these other very large companies, they're still trading at very rich valuations. And so that's where, when you look at price to earnings ratio and things like that, you see a lot of that action in there. Plus, there's been the impact of corporate tax cuts under the prior administration, as well as other variables that have kind of propped them up. And so actually one thing to watch out for is margin pressure. If we do get sustained inflation for another period of time, inflation often looks good at first for stocks, right? Because everything's going up nominally and your prices are going up. But then if it starts to kind of get harder to pass on the price increases to consumers while our expenses are still going up. And so if we start to see margins contract while we're at these very, very high valuations, you could run into an issue. I think the closest comparison, a lot of people look at the dot-com bubble, and I think that was applicable, especially for some of these unprofitable stocks. But I think the closer comparison is probably the late 60s. And we had a period called, basically there were a bunch of stocks that they referred to as the Nifty 50. They were these growth stocks that were considered like you couldn't go wrong owning them. And they were stocks that we know today, like Disney, Procter & Gamble, Xerox at the time, like all these, Coca-Cola, these like up and coming, like blue chip growth companies, kind of mid caps and large caps. And it was like you could buy them at any valuation. Like these are bulletproof companies. And what happened, of course, is that most of them were phenomenal companies. Like their earnings went up tremendously. Their revenues, many of them are just like 10 times bigger today than they were back then. But they were terrible investments for about 15 years because they were overvalued and then ran into an inflationary decade. And of course, the Fed was raising rates a lot, so you had that much worse discount rate to deal with. And so I kind of view today somewhat similarly, in that we have these, they're very profitable large companies in many cases. They have wide moats. So some of them are almost monopolies in some cases. Obviously, they're in that sense, they're high quality companies. Like Warren Buffett is a big shareholder in Apple, for example. It's kind of like that classic wide moat type of investing. But a lot of them are at very, very high valuations. And so we do start to see kind of the Fed trying to tighten a little bit, and you do see higher inflation and some market exhaustion. Some of those I think could have a rough, several years.
All right. Well, Lyn Alden, we really appreciate your insights today and all the insights that you've shared with our viewers. Before we let you go, did you want to share with the viewers any last thoughts you had and where people can find you online?
So I'm at lyndalden.com. I'm also active on Twitter at LynAldenContact, so people can check that out. And I really, basically I think that, we're at kind of a transition point in markets where we're undergoing kind of this monetary shift. And I think there's a lot of moving parts right now. So I think people that are maybe overconfident about what's going to happen over any 6-month period, take that with a grain of salt, because this is a very complex time. But I think, there's some signals to watch. Like I'm watching what happens with credit markets. I'm watching what happens with, the next few inflation prints. Even though those numbers aren't necessarily the most reliable, they do give us information about the rate of change in certain areas. And so I think that investors should have these things on their radar.
All right. Once again, Lyn, thank you so much for your time, and God bless.
Thanks. You too.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.